Welcome back. So far in this series, we have understood what a fund is, who is involved, and how money moves through the fund. Now we are ready to connect all of that to accounting. In this session, we are answering one simple question: what is fund accounting actually responsible for? In simple terms, fund accounting takes everything happening inside the fund and turns it into accurate accounting records and reports. Let's quickly remind ourselves where we are in the series. First, we learned what a fund is and why fund accounting is different. Then we learned about the key people involved, including the limited partners, the general partner, the fund administrator, the bank, and the auditor. After that, we followed the journey of money through the fund. Today, we are looking at what fund accounting does with all of those activities. Let's begin with the main responsibility. If something affects the fund financially, fund accounting should capture it. This includes money received from investors through capital calls or subscriptions. It includes income earned by the fund or its investments. It also includes expenses paid by the fund, changes in the value of investments, and money distributed back to investors. The fund may also receive other income or incur other expenses that are not directly connected to one specific investment. The important idea is simple. Fund accounting tracks the complete financial activity of the fund. However, tracking the total fund is not enough. A fund may have many limited partners, and not every investor is in the same position. One investor may commit more money than another. Some investors may contribute cash at different times. They may receive different distributions, and they may own different percentages of the fund. Because of this, fund accounting must track each investor separately. It is not enough to know how much the entire fund is worth. We also need to know how much belongs to each investor. This is where LP capital accounts become important. Each investor has a capital account that shows their financial position in the fund. Let's look at a simple example. The investor begins with a capital balance of $0. They contribute $200,000. Later, they receive a distribution of $10,000. They are also allocated $30,000 as their share of the fund's profit. After combining all of these movements, their ending capital balance is $220,000. So the capital account tells the story of that individual investor. It shows how much they contributed, how much they received, their share of profit or loss, any allocated expenses, and their remaining balance in the fund. Why do we need these individual capital accounts? Because one fund may have many investors. The fund-level accounts show the total activity of the fund. But the capital accounts show how that total belongs to each investor. Without investor-level records, the fund would not know how much each LP invested. It would not know how much profit belongs to each investor. It would not know how much each investor has already received. And it would not know the current value of each investor's interest in the fund. So remember this distinction. The fund accounts show the total fund. The LP capital accounts show each investor's share. Let's look at a practical transaction. After a capital call, an investor sends $200,000 to the fund. The fund accountant first confirms that the money was actually received. They then record the amount in the fund's accounting records. That money becomes part of the total capital available to the fund for investment. The accountant also updates the individual investor's capital account to show that this investor contributed $200,000. Finally, the transaction is reviewed and reconciled to supporting information, such as the bank records and capital call documents. Notice that one transaction affects two levels. It affects the total fund records, and it also affects the individual investor's records. Now, let's look at another transaction. The GP decides to invest $1 million in a company. The investment decision belongs to the GP, but the fund accountant is responsible for recording the financial effect of that decision. First, the accountant records the investment purchase. The accountant may also allocate the activity among investors based on the fund's agreed allocation method or ownership ratios. They keep the supporting documents and perform the necessary review or reconciliation. So again, the GP makes the investment decision, the fund accountant records what happened and makes sure the records are accurate. Once transactions are recorded and reviewed, the accounting information is used to prepare reports. These reports are the final product of the accounting process. Fund accounting supports the preparation of investor capital statements. It supports the fund's financial statements. It is also used in NAV calculations, investor reports, management reports, and audit information. So fund accounting is not only about entering transactions into a system. The purpose is to produce reliable financial information that investors, managers, and auditors can use. Let's put the complete process together. The limited partners provide capital. The GP makes the investment decisions. The fund carries out transactions. Fund accounting records those activities. The records are then reviewed and checked. Finally, reports are prepared for investors, management, and other users. This is the complete picture. Fund accounting connects what happens inside the fund with reliable financial information. So the main takeaway from today is this. Fund accounting records what happened, tracks who it belongs to, checks that the information is accurate, and turns it into useful reports.